The program examines insurance-linked products and hybrid securities, which provide investors with exposure to risks traditionally associated with insurance markets, rather than conventional financial assets. These instruments allow insurance companies and corporations to transfer specialized risks, such as natural disasters, mortality trends, or credit events to capital market investors. Insurance-linked securities, ILS, are attractive because their returns often exhibit low correlation with traditional equity and fixed income markets, providing diversification benefits within alternative investment portfolios. However, these products also involve unique modeling challenges, event risks, and valuation complexities. The program emphasizes that successful investing in insurance-linked products requires understanding both financial market dynamics and the underlying actuarial or insurance-related risk exposures embedded within these securities. Catastrophe bonds, commonly called cat bonds, are one of the most important forms of non-life, insurance-linked securities. These instruments transfer catastrophic event risks, such as hurricanes, earthquakes, or other natural disasters from insurers or reinsurers to investors. Investors receive periodic coupon payments and principal repayment if no specified catastrophic event occurs during the bond's life. However, if a qualifying event occurs, some or all of the bond principal may be used to compensate the issuer for insured losses. The program explains that cat bonds provide insurers with additional sources of capital while offering investors access to attractive yields and diversification benefits, because catastrophic events are generally independent of traditional financial market performance and economic cycles. Catastrophe bond structures rely heavily on predefined trigger mechanisms that determine whether investors will experience losses following a catastrophic event. Several trigger types are commonly used, including indemnity triggers, industry loss triggers, modeled loss triggers, and parametric triggers. Indemnity triggers are based on the issuer's actual losses, while industry loss triggers depend on total market-wide losses from a disaster event. Parametric triggers activate based on measurable physical characteristics, such as earthquake magnitude or hurricane wind speed. The program highlights that trigger design significantly affects basis risk, transparency, and investor confidence. Investors must therefore evaluate how closely trigger mechanisms align with actual economic losses, and whether the trigger structure introduces additional uncertainty or potential disputes regarding payout calculations. The valuation and performance characteristics of catastrophe bonds differ substantially from traditional fixed-income securities. Cat bond pricing depends on the probability and severity of catastrophic events, expected loss distributions, market demand for insurance risk, and prevailing interest rates. Historical performance has generally been attractive because investors earn compensation for assuming low frequency, but potentially severe event risks. The program notes that cat bonds often perform well during periods of financial market stress because natural disaster risks are largely independent of economic conditions. However, drawbacks include limited liquidity, complex modeling requirements, event concentration risk, and potential pricing uncertainty after major disasters. Investors therefore require specialized expertise to evaluate catastrophe risk models and assess the adequacy of compensation for tail risk exposure. The program also examines longevity and mortality risk-related products, including life insurance settlements and viatical settlements. Longevity risk products are designed to manage the financial consequences of individuals living longer than expected, while mortality-linked products transfer risks associated with unexpected changes in death rates. Life insurance settlements involve purchasing existing life insurance policies from policyholders at a discount to expected future death benefits. Viatical settlements specifically involve policies purchased from terminally ill individuals Investors profit if insured individuals die earlier than expected because death benefits are received sooner. However, these investments involve substantial ethical, legal, actuarial, and liquidity considerations. Accurate life expectancy estimation is critical because investment returns depend heavily on mortality assumptions and medical developments. Mezzanine debt represents a hybrid security combining characteristics of both debt and equity financing. These instruments are subordinate to senior debt, but senior to equity in a company's capital structure, offering investors higher yields in exchange for greater credit risk. Mezzanine financing is commonly used in leveraged buyouts, private equity transactions, and corporate expansion projects. The program explains that mezzanine debt often includes equity participation features such as warrants or conversion rights, allowing investors to benefit from company growth while receiving contractual interest payments. Although mezzanine investments may generate attractive risk-adjusted returns, they also expose investors to significant default risk, illiquidity, and economic sensitivity. Successful mezzanine investing therefore requires detailed credit analysis, structuring expertise, and active monitoring of borrower performance.